Now, we've talked, Martin, about who you are, why you exist, the sort of things that you do. Could we talk now a little bit about the wider environment you find yourselves operating in, and specifically about regulation and law? And my first question is how helpful or unhelpful regulation has been in setting up your business? And I'm thinking here of regulations such as the EU Settlement Finality Directive, the Central Securities Depositories Directive, the Markets in Crypto Assets Directive. There seem to be a lot of these. They've got this pilot regime for CSDs as well. And of course, you have before you this example of ID2S, which was working in the commercial paper market in France, not enjoying the success which it had hoped to enjoy. So how helpful has EU law, Luxembourg law, French law, German law been? And how helpful has UK law been? It's still partially bound by CSDR. We've got these uncertificated securities regulations have been there for a while. We've got this legal joint task force, which has published some papers. And I think you've contributed to some of those papers, actually.
We have.
Tell me, this is a very complex question, but you've got an awfully complex legal environment, let alone and regulatory environment to operate in. How difficult has it been?
It's been a lot of fun. It has been challenging, and I'll certainly give.
Fun, I should think.
I'll certainly give you that. It's. I didn't realize that there were so many law firms in the world, but it looks as if we've spoken to almost all of them. And just before I go in, what I'll probably do, if I may, Dominic, is split that into the regulation followed by the law. But you mentioned ID2S, and I think this is one of the really interesting things that we may later on get on to talk about the Delta Capita deal that Montis has struck. But that's based on settled technology, which is what ID2S operated on. And one of the key aspects behind there, and you've said this is about regulations, really important to us was that our choice of technology is something which, whilst we're using it for access to Target 2, and ID2S used it for Target 2 securities, you still have the fact that the underlying technology we're looking to use has been recognized by the ECB General Counsel and by the French regulators for access to Target 2 securities. And that's where I think the regulations give us a degree of comfort and certainty that what we're setting out on is not inappropriate, but what's really important is now how we apply it in our own way. And that's where I'd probably pick on CSDR first on the list, and it is a long list of regulations you have to comply with. You could also have added in the uncertificated securities regulations, which is a UK perspective. But sitting with CSDR, we've got a huge advantage over the incumbent CSDs, who I must admit I've got a lot of sympathy for them in trying to take 30-year-old systems, 30-year-old processes and organizations and fit them to a regulation CSDR, which came out under 10 years ago. So they had a real problem of how do you get something that's square into a round hole. We, on the other hand, look at it and we see that CSDR, the main objectives of which are to create a regulatory and a prudential regime for CSDs that's common, to increase the robustness and the resilience of the securities settlement systems, and to create a single market for CSD services. We think that's great because it gave us the guidelines that we need to be able to fit into to offer core CSD services, notary services, securities settlement services, and general maintenance services. So that was, for us, extremely good because they set the rules that we had to adhere to. One of the other things they did was they actually filled some of the gaps that Settlement Finality Directive did not specifically require of a CSD. And I'll come to those in just a second. Settlement Finality Directive, though, was already out there, and that seeks to offer, obviously, an orderly settlement finality and legal enforceability of the transfer securities, really key to the business that we have. And from our perspective, we've focused very carefully on our blockchain-based service and how we meet the three aspects of settlement finality. Having it set out was really helpful from a regulatory standpoint. The problem we had was actually how do you fit it in from a CSD and how do you fit it in from a blockchain-based digital CSD. And what we did there was, because SFD doesn't specifically refer to CSDs and doesn't refer to the moment of irrevocability, CSDR does, and we've called that out very clearly. So where settlement finality has worked for us is evidencing the moment that we transfer, that the transfer order enters our system. That's been very straightforward for us. That's we've documented that in detail and shared that with the regulators. The key aspect there is that's the point at which insolvency protection occurs, because it's now in our system and a CSD offers insolvency protection. The second point, which for us is almost simultaneous, is the point of irrevocability, that neither party can actually change the underlying transaction. That is something which CSDR specifically calls out, and that's something that we've identified naturally being a blockchain-based service. We can take a match trade and we can clear and match, which is the enter into the system, and also the irrevocability at almost instantaneously at the same time. And then we come to the third one, which is settlement finality. We're offering it on DVP. Settlement finality comes in, sorry, the legal enforceability of it comes in as settlement finality 3. We've defined all of those in line with SFD. CSDRs help because that's added and filled some of the gap that was there around CSDs needing to do this. And the third bit is we've gone through the lawyers at CMS in Luxembourg to reconfirm that we're able to do that under Luxembourg law, operating under CSDR on a blockchain. And that's worked well. But you mentioned something else. You mentioned two others, MiCA or MiCA, and the pilot regime. MiCA, which comes in next year, offers us the ability to provide an element of cash on chain with e-money tokens, which will come in under the e-money directive obligation. But MiCA does give us the ability to offer e-money tokens as the transfer of value in our CSD services. And we're looking at the detail about how we may wish to do that. Naturally, our starting point is target 2, which is central bank money, fiat, and we're working with a number of the financial institutions around their offerings of deposit tokens, which themselves have been designated as fiat. But the other one that you mentioned was the pilot regime, which we think is quite a fascinating bit of regulation. It's come in as a 6-year term, has a couple of limitations, but congratulations to the European Union, whether it's Parliament, Council or Commission, or in fact all three together, because they were first out the blocks with a set of legislation that enables the adoption commonly across 27 member states in terms of being able to admit or to issue and record securities on a blockchain and to transfer them and to settle them. In our case, a couple of things on the pilot regime. You can have exemptions, obviously, on the recording on a blockchain or around integrity of issuance. You can have exemptions around segregation of assets, cash settlement, settlement finality, also on your participants, and around things like CSD links and also settlement discipline. But there's a couple of things with the pilot regime which are challenging, we think. The first is that it applies limits and thresholds on the size and value of the financial instruments that are admitted for trading on a MTF, but also recorded on a blockchain CSD. So from our side, we think the challenge with those thresholds is the way this market can develop is very early in that 6-year period, and it's only started a couple of months ago in terms of being able to apply for exemptions. Very quickly, we see those thresholds being hit, which would then restrict the ability to develop further. The second aspect is that because it's 6-year term, you must evidence that there's a way to reverse your issuances out back into the conventional market. And if we're looking at natively digital securities as well as tokenized, that's quite a significant limiting factor as well. But the pilot regime brings in some other fascinating ideas, because you've got a DLT financial market infrastructure or market infrastructure, which can have an MTF or a CSD. And so we've looked very seriously at the opportunity to combine MTF and CSD services under the pilot regime to create a DLT trading and settlement system. Still undergoing the evaluation of whether we do apply for exemption, but it's a fascinating opportunity there. But our challenge is that we actually want to go out first and get our full scope CSD license, and the pilot regime would only offer a limited scope. So great regulation there. You've seen, and you mentioned about the UK as well. The UK, through the FSMB, the Financial Services Marketing Bill or Markets Bill, has given the secondary legislative powers to HM Treasury. That means that they can make changes to underlying legislation in the UK to support the adoption of digital securities and the use of blockchain technology, amongst other emerging technological innovations. The UKJT, the UK United Kingdom Jurisdiction Task Force, you're exactly right. We've put submissions in there. They've come out with some very interesting findings, and we believe that we're probably within a whisper of being able to offer our services in the UK as well. But who knows? The only thing that we've applied for at the moment is Luxembourg, and that's where we're very clearly focusing on. And I'll pause for a moment, Dominic, because this would naturally lead me in to talk about the laws.
Well, I was going to ask you about Gibraltar as well, because you looked at Gibraltar first, not least because they'd passed this blockchain law, and so it seemed a natural place to go. They also had this special access to the European Union markets, but you decided not to go there in the end.
We've paused it. I think first of all, we worked for over a year with the Gibraltar government and with the GFSC out there, with several law firms yet again, doing an excellent piece of work out there, because Gibraltar is a British overseas territory, and it has CSDR available to it, but not enshrined in law at the moment. But it has it as a result of the UK and Gibraltar being part of the European Union. And what we've been looking at with the government and the regulator out there was, as part of a working group that was set up, what would it take to put that in place? Gibraltar hasn't got a CSD, and also Gibraltar hasn't got a central bank. So there are some elements there where you need to do it in a slightly different way. They also don't have the uncertificated securities regulation, which is the UK approach to handling dematerialization and so on. But they have got some excellent DLT, distributed ledger technology principles already in place. There are 10 of them. They are a market which does give access directly into London through the GAR, the Gibraltar, I think it's Gibraltar authentication regime, and one of the other aspects to look at is it's probably one of the most logical places to consider looking at a natural persons regime, because as you may well be aware that most of the regulations, Settlement Finality Directive, CSDR and others, it all talks about legal entity. And if we look at where the world's going to, natural persons is also a key component of that, where you and I could choose to custody our securities at a CSD, and that we'd want to be able to instantaneously use our smartphone and transfer them back and forth. So Gibraltar was a serious consideration, but it wasn't that we decided not to. The laws aren't yet in place to allow us to apply. And if the laws and the authorization for the regulator is not there, then the regulator can't actually accept our application.
Okay, it sounds like Gibraltar might be useful in a decentralized, disintermediated future.
It's certainly a very innovative regime, and I must say congratulations to the individuals there, Albert Isola, the minister, Paula Stengo, and everyone at the GFSC. They are very innovative, but this is a big step for them.
Yeah. You mentioned you were within a whisper of being able to offer your services in the UK as well. One of the things the UK has offered is to revitalise its regulatory sandbox. Is that helpful to you, or is it too late for that?
No, it's certainly helpful, and we have had discussions with HM Treasury, same as we do with the Bank of England and so on, because none of this is something where we would ever want to cause a surprise. We are trying to step very deliberately, very clearly within the regulations and the laws that apply. The HM Treasury FMI sandbox has very strong appeal to us. From our perspective, we would love to be able to be authorized in the sandbox and evidence that we are a credible full scope CSD at the appropriate stage, having gone through all the checks and balances from the regulator's perspective and from the central bank, and then actually come out of the sandbox as a digital CSD. But today, we look and we contribute. We've also expressed very clear articulation of the differences between common law and civil law with the support of lawyers, and how we can operate under CSDR, because that's still the UK regulation for CSDs, but also other countries as well. So from our own perspective, we are looking very carefully at what are the right regimes to be in place. And the HMT FMI sandbox is a very logical extension of what a place for us to prove what we're doing. But it's not the only one. I mean, for us, the laws in Luxembourg already are extremely advanced, innovative, and it's a very mature location with innovative regulators and central bank and capital market.
Yeah, and lots of fund issuers, which I'm sure we'll come to a bit later. But
yeah.
One jurisdiction in which organizations like yours have stepped successfully out of regulatory sandboxes to become thriving businesses is, of course, Singapore. And I wondered where you think the earliest adoption of the kind of services that you're offering is going to occur. I mean, I look at Singapore, it seems to be very progressive compared to the UK or Europe or the United States. So where do you think the earliest adoption jurisdictions are going to lie? Is it going to be in Asia or here in Europe?
I think there's it's going to be a hybrid. I think there are three regions you'd look at. You'd look at, from an Asia Pacific point of view, yes, Singapore, MAS have been very advanced in their willingness to embrace new technologies. You see services like Bondi Value and so on developing out in Singapore. It certainly is attractive, and it's a regime and a jurisdiction that we have looked extremely closely at and continue to monitor. But we've got to walk before we run. Second region that you could look at is the Middle East, because there are some around Abu Dhabi and so on, there are some significant changes and adoption that's been going on that could make it very attractive. But for us, it's starting closer to home. And when our discussions sort of led to the fact that it was going to take Gibraltar a little bit longer than expected to get the legislation in place, for all the right reasons and very supportive of it, we pivoted and we looked at the European Union. And I used to be a French taxpayer based in Paris. I've worked for 3.5 years in Brussels, or commuted out there. And we looked and we saw that there were some very attractive changes going on. The first one was the one, and you referred to ID2S, was the French law, or the French laws around blockchains. And that started in 2016 with the SAPIN2 Act. Interesting enough, from their perspective, it started from an anti-corruption and economic modernization perspective back in 2016. And that granted the powers to reform the securities laws to allow certain securities to be recorded and transmitted on a blockchain. That then developed with ordinances, was it 2017, which was the next step to extend the ability for those securities to be unlisted securities that could be issued, registered, transferred, and then to more recent regulation, which was, I think it was, no, in fact, yes, it was the 2018 was the decree that they came up with, which is the decree under which SocGen in 2019 issued their first 100 million euro covered bond, which was registered on the Ethereum blockchain. So those laws were helpful, and as you saw, that enabled Orange with ID2S to create a digital security, but in their case for conventional securities with commercial paper. So we looked at the French laws very carefully as to whether that would be the right place for us. We thought highly innovative. We understand the regime. But we also looked at Germany, where in 2021, the Electric Securities Act came in. This removed the requirements for securities to be documented and allowed for them to be entered onto an electronic register, electronic securities register, in this case, DLT. It also gave the first steps to allow for electronic bearer bonds to be issued. And we saw that as a very progressive step forward. But the one that caught our eye most, and the one that we think has got the best foundations for us as a digital CSD, is Luxembourg. And we followed on from 2001, where they brought in the law on the circulation of securities, very much a technology innovative driven legislation. This enabled us to book securities onto securities accounts, maintained, as they call them, by account keepers. We then saw in 2013, they brought the laws in around dematerialized securities, which meant that new forms could be created for securities, bearer, registered, and dematerialized, and that the primary level, at the primary level, the issuers could now issue dematerialized securities into what's called issuance security accounts. They then brought two, in fact, they've just brought out the third blockchain law. So 2019, 2021, and 2023 blockchain laws 1, 2, and 3 mean that those securities accounts can be maintained on a blockchain. We can legally transfer securities between accounts on blockchain. And in addition to that, we can now have the issuance security account maintained, operated in the same way. The most recent law that they brought in, Blockchain Act 3, was very much to accommodate the pilot regime in terms of the legislation. So from our side, that's the best environment for us. We can do a natively digital issuance onto our blockchain. That means that you don't have to have all of the documentation, all of the paper records and so on, that we are the golden source of issuance, and we can tokenize, but we can also support conventional securities. Fascinating raft of different regulations, fascinating raft of different laws, and we do see that there will be more and more harmonization. But at the moment, we're looking and saying the marketplace is already, for digital securities, is already running at a very significant pace. And if we want to support the settlement of MiFID compliant securities in today's world digitally, then Luxembourg's the right place to apply.